Okay, so while everyone else is obsessing over language models, Pony AI just proved that actual street-level autonomy is a real paying business. Welcome to Earnings Unscripted. It is May 26th, 2026, and today we are looking at Pony AI, ticker PONY, and a first quarter that honestly breaks a lot of tech stereotypes.
Yeah, it really does. I mean, the growth alone is hard to ignore. Total revenue came in at $34.25 million. That is up exactly 145% year over year. But what really jumped out at me is how they are achieving it without blowing up their cost structure.
Which is extremely rare in this space. And speaking of blowing things up, quick reminder that this podcast is just our personal opinions, not financial advice, so please do not bet your actual life savings on our hot takes. But Miro, you mentioned costs. Their operating loss stayed pretty flat, right?
Right. Operating loss was negative $58.34 million, so practically flat compared to a year ago. But because the top line is scaling so fast, their operating margin narrowed drastically. It went from, negative 401% a year ago to negative 170% this quarter. The strange part, though, is that the net loss actually widened.
Right, to negative 53.51 million. But that was not an operational thing.
No, it was a baseline effect. Last year, they had this huge cushion of realized investment gains. Remember how we talked about them playing the market previously? So the core operations are actually much healthier now, even though the bottom line looks a bit worse on paper. Earnings per share just stayed totally flat at negative 12 cents.
And the market reaction was, well, it was a total roller coaster. The stock had a brutal quarter going into this, down over 42%, and earnings day just whipped everyone around.
Total whiplash. It gapped up hard pre-market, touched 1088. Then the regular session opened and it just cratered, sold off sharply all morning.
But it managed to stabilize by the afternoon.
Yeah, it consolidated in the mid-9s and actually finished the session up 4.82% relative to the prior day. So it was a net positive earnings reaction. Just an absolutely punishing intraday ride for anyone watching the tape.
Jeez. Well, the actual business feels much less volatile than the stock. Their robotaxi revenue surged nearly 400%, coming in at $8.57 million. And there was this amazing story from a concert in Guangzhou this past Labor Day.
Right, the stadium bottleneck.
Yes, 220,000 people trying to leave all at once. Absolute gridlock. The government actually directed attendees to use Pony AI, and they just hauled 3,000 stranded fans until 2 in the morning. No human drivers, just quiet robots doing the heavy lifting while regular taxis were stuck.
It is a massive operational flex. It proves they can handle extreme urban stress. But here is the thing I found most interesting. Robotaxis are they're not even their biggest segment right now.
Wait, the consumer taxis are not the main revenue driver?
Nope. The real money this quarter came from a segment they just quietly renamed to Intelligent Solutions. It is their B2B hardware arm. They sell autonomous domain controllers for, low-speed logistics rovers and sweepers. That segment brought in $15.48 million.
Wow, that is almost double the robotaxi revenue.
Exactly, and it grew over 246% year over year. So while the market is completely focused on the sci-fi story of robotaxis, they are quietly printing money selling enterprise hardware.
Okay, I love that. The flashy robotaxi company is secretly a logistics hardware vendor. All right, let's get into the details on how sustainable that actually is.
Well, sustainability comes down to unit economics, and that is exactly what they proved this quarter. I think this is the most critical detail in the entire earnings call. The CEO, Dr. James Ping, explicitly stated they achieved citywide unit economics break-even in Shenzhen this past February. And that follows the exact same milestone in Guangzhou last November.
An entire Tier 1 city turning a profit on the unit level. Sure, but are they just heavily subsidizing those rides to get utilization? You know, the classic Silicon Valley playbook of giving away rides just to pump up the active user numbers?
Actually, no. That is the part that surprised me. They are not doing the race to the bottom. Their CFO, Dr. Leo Wang, made a point to say, and I will quote this, Our effective fare rate per kilometer remains above entry-level pricing on ride-hailing platforms. So people are literally paying a premium to ride in a robot instead of a budget human driver.
Oh, wow. Okay, I suppose that makes sense because if you think about it from the rider's perspective, you are paying for absolute consistency. No awkward small talk, no weird driving habits. You just get the exact same experience every single time.
Exactly. But delivering that boring consistency requires a very specific architecture. And they are completely bucking the current AI hype cycle to do it.
You mean they're ignoring the whole generative AI boom?
Well, they're intentionally avoiding pure large language models for the actual steering logic. CTO Tiancheng Lu explicitly shot down using LLMs to drive the cars. He said, driving has zero room for mistakes. A language model basically gambles on the most likely next word. But he pointed out their model does not pick the single highest probability path. Instead, it chooses the action that ensures safety under any probability.
That is a brilliant distinction. I mean, if a chatbot hallucinates a historical fact, it's slightly embarrassing. A robotaxi hallucinates a crosswalk, it's a tragedy.
Right, and they actually do not even trust the software blindly. They've built hard physical vetoes into these vehicles to protect the assets.
Wait, physical vetoes? Like a giant red stop button?
Kinda, yeah. Water weighting sensors.
Okay.
Think about it. During a heavy downpour, camera systems and AI algorithms struggle to measure how deep a muddy puddle is. So instead of letting the algorithm guess, Pony just installed dedicated physical sensors under the car. If it detects standing water above a certain depth, the car just refuses to proceed. The hardware completely overrides the software so the car does not hydroplane or destroy its electrical chassis.
I love that. It is like a hyper-advanced robot that just turns into a cat and refuses to get its paws wet.
Pretty much. But financially, that is brilliant CapEx preservation. The fastest way to ruin your margins is to have your AI confidently drive $30,000 of compute hardware into a flooded intersection. It is ground-level pragmatism.
So they are building highly conservative robots. And you mentioned the hardware cost. That bill of materials has to be dropping too, right?
It is dropping aggressively. They are tracking to get the total build cost for their Gen 7 vehicles under 230,000 RMB. That's roughly 33,000 US dollars per car by mid next year. At that price point, fleet expansion stops being a massive financial burden and turns into a highly repeatable deployment cycle.
Which perfectly explains the operating loss narrowing so dramatically. It's not just about bringing in more revenue, it's about creating a machine that naturally gets cheaper as it scales. So if the unit economics are actually clicking in China right now, where does that leave their deployment targets for the rest of the year?
It leaves them basically stepping on the gas. Look, management just confidently raised their full-year guidance. The CTO, Tiancheng Lu, noted they are building on their robust growth momentum and hiking the revenue target to over 3.5 times what it was last year. And they are pushing the year-end fleet target to over 3,500 vehicles.
Over 3.5 times? That is a massive acceleration. But are they just flooding the domestic market, or is this where the international rollout finally gets real?
It is actually a dual-engine approach, but the international side is fascinating right now. They are aggressively pushing into Dubai and Zagreb, which is Europe's first commercial robo-taxi service. They're partnering up with Uber and Verne. It really looks like they're building this multinational regulatory wedge, while the Western companies are still stuck in R&D.
That is so smart. It is, it feels like they're grabbing territory while everyone else is still debating theory. But I do have to ask, if they're growing a hardware-heavy business that fast, there's an obvious supply chain risk, right? What is powering all these autonomous controllers they're suddenly selling?
Right. That is the exact soft underbelly here. Their SEC filings are very explicit about this. They rely heavily on advanced semiconductors, specifically things like NVIDIA Orin chips, which are sitting right in the crosshairs of U.S. export controls. So if geopolitical trade restrictions tighten, that entire intelligent solutions segment, the one quietly paying the bills today, well, it could face a sudden bottleneck.
It's It's just the ultimate irony, isn't it? You solve the impossible software puzzle, you prove out the citywide unit economics, and then your entire trajectory hinges on a trade war you cannot control.
Yeah, the AI doesn't have to worry about hydroplaning anymore, but it can't navigate customs. That's the real bottleneck we need to watch next quarter.
That's exactly it. Well, it definitely makes the next few months high stakes. We will be right here to see if the robots keep cruising or if the supply chain finally bites back.
And hey, if you like having these breakdowns just quietly show up in your feed, go ahead and follow the podcast. We are actually exploring what happens when you use AI to turn a 50-page SEC filing into an actual conversation. So we would really love to hear what you think. You can send us feedback or drop a ticker request anytime at earningsunscripted@datamadness.ca or just grab the X link down in the show notes. Thanks for hanging out with us.
See you after the next bell.